Good morning, everybody. Welcome to today's Morning Blast. If someone can give me a quick thumbs up to see if they can hear me, because I've had to unplug and replug in my microphone and I'm not really sure if it's working. Perfect. Thank you. Great. So happy Monday, everyone. It's what day is it? It's the 17th of March. Obviously myself and Mr. Michael Brown are here to jumpstart your trading day with an explosive daily preview. Okay, that's enough thumbs up. Thank you, everyone. But before we do, let's crack on with the legal. So as usual, nothing discussed in this spaces session, the constitute trading or investment advice, or infers any kind of endorsement by PIQ Global Limited, PIQ or PIQ Suite, or that of the hosts, which, as you know by now, is Mr. Michael Brown and myself, Mr. Ryan Paisley. But before he cracks on, just a quick shout out to Zach and Cam, who are obviously part of Team PIQ as well now. Cam is bringing the crypto stuff to the table, and Zach for the overnight news roundup, which has already gone out this morning because I've been very proactive. And also, I think Zach was skiing at the weekend. He might even still be on the slopes. I don't know. But anyway, Michael Brown, how are you?
Well, good morning, Ryan. Good morning, everyone. I was very well, but is Judith really on the bloody ski slopes?
Well, I did see an Instagram post from Judith Chalmers at the weekend where he was just on a lift, on a chairlift somewhere. But yeah, the good news is the weather looks shit.
Yeah, what a shame. What a shame. You know, my heart bleeds for the poor little slacker.
How are you anyway? All good?
I'm very well, thank you. I'm very well. I'm full of the vitality this morning. I'm already on my third coffee in my hand as we speak. So,
and you've made it into the office?
And I've made it into the office, and the air conditioning has been fixed. Touch wood.
God, living the dream.
So yeah, and a busy week ahead as well. So all is well this morning.
Very best crack on.
We best. Let's do so by... Yeah, well, that's exactly what I was doing. Let's crack on then. In terms of last week, we actually ended on a relatively positive note towards the back end of last week, with the S&P 500 ending Friday up by about 2%, the Nasdaq 100 rallying by about 2.5%. Both of those benchmark indices notching their best days since the 6th of November last year, which was, of course, the session after the presidential election. But I think it's far too early to say that either of those is out of the woods. We are still quite considerably below the 200-day moving averages in both. There is obviously still a huge degree of policy uncertainty out there, most notably in the realm of trade. And I think the move that we saw in the equity space on Friday was more a kind of relief rally on the fact that there was really no news on Friday, as opposed to a market that is, sort of sounding the all clear. And as to the sell-off being over, and as if to evidence that, we do see futures taking a leg lower this morning. Both the S&P and Nasdaq futures trading down by around about 0.5% as the European session gets underway. That positive risk tone was also seen in the Treasury market, where we saw losses across the curve. The 2-year yield rising by about 6 basis points, trading north of 4% once more. The 10-year yield rising about 4 basis points, trading north of 4.3%. Interestingly, though, that move higher in yields couldn't put a bid into the dollar, with the dollar index ending Friday marginally softer, down by about 0.2%. The greenback gaining ground against most major peers, although we did see sterling underperform, with cable trading down by about 0.25% after the surprisingly poor January GDP data, which did point to an economic contraction in the month as 2025 got underway. In terms of other big market moves, obviously the main one that kind of stole everyone's attention was gold, which did on an intraday basis trade north of $3,000 an ounce for the first time ever. But we did unsurprisingly see a bit of profit taking at that big figure, and the yellow metal actually ending the day marginally in negative territory. But nonetheless, it did give us all a chance to send our $3,000 an ounce headline and puns as the week drew to a close. In terms of fundamental catalysts, as I said, a little bit thin on the ground on Friday, to be honest, but a few things to run through nonetheless. The first is on the data front, we had the latest consumer sentiment reading from the University of Michigan as the week drew to a close. That gauge falling to 57.9 per the preliminary March reading, down from the prior 64.7 and below the forecast range. That headline metric is also the lowest level since November of 2020. 2022. But I think it's important to once again recall that there is a huge political skew in this data. Sentiment, if we break it down by political affiliation, sentiment among Democrat voters fell to 41.4 for a prior 51.3. Among independents, it held steady at 57.2. And among Republican voters, it slipped marginally to 83.9 for a prior 86.7. So the nub of this is, if you're a Republican voter, you think that the economy is absolutely amazing and you're fully behind what President Trump is doing. If you're a Democrat voter, you think the economy is utterly terrible and you hate everything that the White House is doing. Now, I don't know about you, Ryan, but I think I could probably have told you that without the benefits of the University of Michigan sentiment survey, which, interestingly, and I didn't realise this, and thank you to Tim at Think Money for pointing this out towards the back end of last week, the survey size is about 600 as well. So it's not even a hugely sort of representative sample of the US consumer. For the same reason, I would be taking the inflation expectations components with a bit of a pinch of salt as well. Just for the record, the 1 year inflation expectation, that rose to 4.9% from a prior 4.3. The longer run, so the 5 to 10 year expectation, that rose to 3.9% from a prior 3.5. And that's the highest level in over 3 decades. But again, I don't think we can read too much into the data. There's way more noise than signal associated with these figures.
Yeah, agreed. Completely agreed.
Anyway, now that sort of mini rant is out of the way, a few other bits and bobs from Friday here in Europe, well, across the channel. In true EU fashion, the German CDU, CSU, SPD, and Green parties have done a bit of a fudge and reached an agreement on the debt package. Of course, you'll recall this is the 500 billion euro special defence fund, which is going to sit outside of the debt brake and effectively allow Germany to deliver a whole host of fiscal stimulus. They've also said that of this spending, the quote climate and transformation fund will get 100 billion euros. That's basically a win for the Green Party just to get their support. There's going to be a vote on this in the German Parliament this week, which should now pass. That is due to take place tomorrow. I did, though, find it slightly ironic that incoming Chancellor Friedrich Merz was saying, and I quote here, fiscal discipline remains important. He's about to increase debt to GDP by about 12%. But, if he says it's important, then apparently it is. In terms of other bits and bobs on the geopolitical front, Trump was waffling away on Friday, saying that they had some very good talks with Russian President Putin. Over the weekend, Trump said that him and Putin are going to have a phone call on Tuesday. So that will be tomorrow. We will, of course, pay close attention to that to see what happens, because, of course, thus far, at least, Putin has kind of said he's open to a truce, but the conditions attached to his acceptance of such an agreement are such that make it pretty much impossible for it to be agreed. So we will see what happens there.
It's probably worth me just given some of the geopolitical headlines on this exact topic whilst we're talking about it.
Go on, otherwise we're going to have to come back on ourselves, aren't we?
Yeah, exactly. So just further to that, what Putin's saying at the moment is he wants, quote, ironclad guarantees that Ukraine won't join NATO. Oh, you're right.
Yeah, that was me throwing my coffee cup in the bin, don't worry.
Oh, okay. Zelensky called for Western clarity on security guarantees, including potential foreign troop presence. The EU foreign policy chief Kallas said Russia's demands show it does not really want peace. And finally, on this topic, before Michael carries on, UK PM Starmer says allies, aside from the US, are preparing to bolster Ukraine under a potential ceasefire scenario. So that's the further headlines according to Zach and his overnight news roundup. And I can confirm he is on the slopes. So,
dearie me.
Back to you in the studio.
What a disgrace that boy is. He has put together a few comprehensive headlines, so I will let him off. But yes, so we'll see. We'll monitor that one as the week goes on. The other thing, just from Friday, obviously, Trump was meeting with the NATO Secretary General, Mark Rutte, who, of course, used to be Prime Minister of the Netherlands. And he actually said that he believes the NATO defence target needs to be above 3%, which I don't think anyone in NATO, maybe the US are reaching that, but certainly not most of the other nations. The UK getting to 2.7% next year. So that's one to keep an eye on in terms of defence spending. A couple of other bits and bobs just from Friday before I give back to you, Ryan. Firstly, we heard from Howard Lutnick again. He seems to be a bit of a constant fixture on the television at the moment. This time he was speaking in his usual obsequious manner on Fox Business.
Word.
A perfect word to describe him, I think, if I do say so myself. The key takeaway from this interview, when you cut all the bullshit and bootlicking, was Lutnick saying that the Trump administration, and I quote here, will own the economy from the fourth quarter onwards. When you couple this with what Scott Bessent was saying over the weekend about how they're not really concerned about, a short-term market correction, and they believe in this long-term gain strategy, basically the administration are now saying to us quite openly, there is going to be a bit of pain ahead, and anything that happens before October, we're just going to blame it on Biden and the inheritance we got and how the economy was brittle underneath, etc., etc., etc. So this really confirming two things. Firstly, that there probably isn't a Trump put, and secondly, that they are going to massively front load all of the Doge stuff, all of the tariff stuff, basically all of what they want to do in the hope of getting the pain out of the way now, and then engineering an economic turnaround from the fourth quarter onwards, perhaps a market turnaround as well, if with a few Fed cuts thrown in maybe, and that will then juice things into the midterms, which are of course in November of 2026. So I thought that was an interesting interjection from Lutnick.
Yeah. I saw just quickly on that. I did see Brent Donnelly. If you don't follow him, what you do in your life, definitely give him a follow. He raised this as well and basically said exactly the same as you. Although he said rather than there being no put at all, he said look, the put's much lower if there is one. But yeah, you're right. It does seem to be they're kind of just saying, look, guys, we don't really care about what happens to the stock market right now. We just want to get everything out of the way. And the thing is, I think you've mentioned it before, Michael, a couple of weeks ago, that there was a chance this would happen anyway. And then so then by the time they try and get this turn into the market, it times very nicely with the midterms. And then that really gives that boost, because obviously everyone has very short memories. So if you're just looking, if you're a voter and you've just seen the stock market rally 25%, you're gonna be like, oh, this is brilliant. But you might have forgotten that it fell off 25% before that point.
Yeah, we're still lower than we were, kind of thing, but the percentage change makes it look more favourable. I agree. I think I'll just reiterate lastly on that what I've said before, and I said in my note this morning, it's a politically expedient strategy. If you're a political strategist, you go, this is a fucking great idea. From an economic point of view, yeah, great. It's very easy to crash things. It's quite hard to recover things.
You need a lot of things to go right.
Absolutely. Anyway, two other things from me lastly before I move on. Firstly, DeepSeek. Anyone remember them? Of course, they came out with this AI model at the end of January. They're running the company in exactly the fashion that you would expect. They have taken some employees' passports and forbidden them from traveling abroad freely due to, quote, national security concerns. That sounds sketchy as hell, to be completely honest with you. And last but by no means least, just
do that to Zach.
Yeah, actually, we probably should. A little bit of human trafficking never goes amiss. Last but by no means least, news from the credit ratings agencies, which I wouldn't normally cover, but this one is slightly more interesting. Moody's on Friday night, they raised Greece to investment grade, which means that all three of the major credit agencies, Fitch, S&P and Moody's, now have Greece as investment grade. Imagine that headline about a decade ago. I don't think anyone would have seen that on the cards. The turnaround that we've seen there has been quite something. And to be fair, credit where it's due, because the pigs are outperforming France and Germany at the moment.
Well, you could say the pigs have found a truffle.
Oh, Jesus Christ.
I'm not happy with myself for that one.
That's terrible. That is utterly terrible.
I'm sorry. I'm going to go and have a word with myself after the blast.
I think you should.
Thank you. Is that you done?
It is, yeah. Forever now.
Yeah. Thank you very much, Mr. Michael Brown. So, some headlines via Zach, who is on the slopes as we speak for the overnight news roundup. So, starting off in macro and policy, Trump on tariffs. President Trump reiterated no exemptions for the steel and aluminium tariffs, promising reciprocal and sectorial tariffs on April the 2nd. As Michael alluded to earlier, Treasury Secretary Bessent said no guarantees against recession and the US must reduce government spending. Secretary of State Rubio signaled the US will soon impose global tariffs, then seek bilateral deals. The Senate passed a stopgap spending bill averting partial government shutdown. Trump's to meet oil executives in his first large group session with the sector since taking office. That's according to Newsquark. Over 1,000 US meat plant export registration contracts have been left to expire in China. These were put in under the 2020 Phase 1 deal. Everyone remember that? This could potentially hurt I think it was like a $5 billion industry shipping over to China. So one to definitely keep an eye on, because I can't imagine that Trump's going to take that laying down. Speaking of China's consumption plans, the State Council announced a special action plan to boost domestic consumption income, including raising incomes and starting childcare subsidies. It also hinted at stock market stabilization. Retail sales in China quickened in between Jan and Feb, according to Chinese data, obviously, pinch of salt, though the property sector remains weak. That's according to officials who also signaled caution on monetary easing. Chinese securities watchdog is to crack down on fake info in stock markets, citing AI-driven disinformation.
Hang on.
Yeah.
Fake in China cracking down on fake info. They're the ones putting it out most of the time.
No, so this is the thing, right? They don't like other people's fake info.
Yeah, fair point.
It has to be their fake info, otherwise you're into the gulag or whatever the Chinese equivalent is.
The
Global
Labour camp.
CEOs, well, yeah, global CEOs from Qualcomm, Aramco, etc., heading to Beijing for a top exec gathering. Some expected to meet President Xi on March 28th. So be on alert for headlines around that period. Japanese JGBs, the 30-year yield hit 2.62%, a high since July 2006. PIMCO shifted from underweight to neutral on JGB, seeing value at the long end. PM Ashiba's approval rating has hit a record low following gift voucher controversy. What we got now, Germany's spending and EU trade. Germany's parliament, as Michael alluded to, have approved the massive borrowing boost to defence and growth side. Final vote is set for March the 18th, which is tomorrow, all day. Morgan Stanley expects stable Bund supply in 2025, sees issuance surge in 2026, but said the post-fiscal package sell-off is largely done. In the EU now, France's PM calls EU's whiskey targeting tariff an error, wants urgent talks to avoid further US-EU trade escalation. The American Chamber of Commerce warns the US-EU trade spat threatens 9.5 trillion with a T in mutual commerce. Deutsche Börse's CEO, that's the German exchange for those not aware, their CEO urges a big bang to channel more investment into European stock markets. Just some other UK European notes. France ruled out reversing the retirement age from 64 back to 62, citing pensions pressures. Spain's economy benefits from remote worker inflows, according to its central bank governor. The UK government plans more spending cuts, including welfare, to spur growth, with ministers dropping a disability benefit freeze. Housing site Rightmove says the average listing prices rose in March amid closing stamp duty window. Some quick Asian headlines for you now. South Korea's chip exports to China, they fell sharply. That was just shy of 32% down year on year in February, overshadowed by US tech restrictions. The US wants broader market access in South Korea, particularly agriculture and tech. Taiwan to raise power bills by 6% next month for households and small businesses. What else we got? UBS, in market wise, they lift gold target to 3,200 an ounce, citing a possible protracted trade war. Some geopolitical headlines now for you. In the Middle East, primarily, the US will keep hitting Yemen's Houthis until they cease maritime attacks. That's according to the Secretary of Defense. The Trump administration weighs new travel restrictions on citizens from dozens of countries. Canada is reconsidering its F-35 fighter jet purchases, exploring alternatives as tensions with Washington simmer. Turkish President Erdogan spoke to Trump about the Russia-Ukraine war and restoring stability in Syria. President Xi declined an EU summit invitation, to mark 50 years of diplomatic ties. And finally, from me, just a few from the corporate area, corporate markets, equities. Oracle and TikTok. Oracle accelerating talks with White House to run. Sorry, I just got a message then. To run TikTok's US operations through concerns that remain about ByteDance role. OpenAI and Elon Musk, both parties agreed to fast track a trial over OpenAI's pivot for profit status. But to Hathaway has been widely reported this morning. They've boosted stakes in 5 Japanese trading houses. That's gone to regulatory filings. What else we got? BMW and VW. BMW will integrate with Huawei's HiCar into new local models from 2026. And Volkswagen FAW to launch 11 new China exclusive models aiming to reverse market share loss. And I reckon, Baidu, sorry, in AI news, because everyone loves a bit of AI news. Baidu have launched 2 new AI models, including one focused on reasoning, competing with DeepSeek's leading AI. So potentially a bit of a Chinese AI war brewing. But that's it from me. Back to you in the studio.
Good stuff. Thank you, Ryan. Right, in terms of this week, then, it is a bit of a monster one, to be completely honest with you, in terms of the data docket. And of course, also market participants continuing to pay close attention to political and geopolitical events out of Washington, D.C. I'm sure it won't be long until we get our first Trump Truth Social post of the week. And we also have that Trump Putin call scheduled for Tuesday as well, among other bits and bobs that could pop up through the next 5 days or so. In terms of scheduled events, though, we kick things off today with the latest US retail sales figures due at 12:30 this afternoon, London time. Headline sales seen having risen by 0.6% on a month-on-month basis in February, which would be a rebound from the dismal 0.9% decline that we saw in January. Of course, plenty of focus on the data amid the ongoing jitters and worries about a potential US economic slowdown. And once again, the market will not be in any mood whatsoever to forgive a downside surprise were it to pan out a little bit later on today, with that only serving to perpetuate the fears that are already ongoing about the state of the US economy. In terms of the remainder of the week, then, going through day by day is probably the easiest. Tomorrow we have housing starts, building permits, and industrial production out of the United States, as well as the latest inflation figures from Canada and March's ZEW sentiment surveys out of Germany. The expectations gauge, that previously was at 26, this time around it's seen soaring to 50.3. So clearly that's what 500 billion euros worth of defence spending does to sentiment in Europe's largest economy. Moving through into Wednesday, we kick things off very, very early indeed with a policy decision from the Bank of Japan. No change expected, with rates due to remain at 0.5%, although focus will obviously fall on the BOJ's guidance as to the potential timing of further rate hikes and also whether indeed there is a ceiling on how high the rates may go. Bloomberg Economics pointing out that UEDA may want to flag 1% as a potential ceiling in terms of the BOJ's policy rate. Comments on JGBs will also be of particular interest during the press conference, given the moves that Ryan alluded to a moment ago. Also on Wednesday, we have final inflation figures due from the Eurozone, but the main event, of course, comes from Washington, D.C., with the latest FOMC decision. The Fed expected to hold steady the target range for the Fed funds rate between 4.25% and 4.5%. The statement also likely to be broadly a reiteration of what we saw at the January meeting, noting that risks to the dual mandate remain roughly in balance and that the outlook remains uncertain. They may marginally downgrade their assessment of economic growth, although that is a little bit of a 50-50. In terms of the decision of the meeting itself, because it's a March meeting, we also get an updated summary of economic projections. Obviously, we'll run through this in more detail on the blast on Wednesday, but it is likely that growth expectations are nudged a little bit lower, inflation expectations nudged a little bit higher, at least in the short term, and the dots will probably be unchanged, pointing to a median expectation of 50 basis points worth of cuts this year. Of course, we'll also on Wednesday get a press conference from Chair Powell himself. Thursday is a very, very busy day indeed. We kick things off with jobs data out of Australia. We then move through into jobs data out of the UK, which is not even worth the paper that it's written on, but unemployment nonetheless is expected to have held steady at 4.4% in the 3 months to January. But with the ONS, it could be 2.4, it could be 8.4. We've got no idea whatsoever. Thursday is also a busy day of policy decisions. The Swiss National Bank, they are expected to deliver a 25 basis point rate cut, which would lower their policy rate to 0.25% in what is probably going to be the last cut of the cycle in Switzerland, as they won't want to be going back to the ZERP and NERP days that we all thought we had nipped in the bud. We also have a decision due from Sweden, with the Riksbank set to hold rates steady at 2.25% on Thursday morning. And then we move down the road to Threadneedle Street, where the Bank of England's Monetary Policy Committee are likely to hold bank rates steady at 4.5%. Although there's really no consensus around the vote behind that decision. It could be, my expectation is it'll be an 8-1 vote, with just Dingra dissenting in favour of a 25 basis point cut. But there's a decent case to be made that either Mann and or Taylor could also dissent in favour of another cut following the 25 basis point move that they made at the February meeting. The Bank of England's policy statement is likely to be broadly unchanged. And there are no new economic forecasts due from the bank this week. Also on Thursday, we get the weekly jobless claims data out of the States, where the initial claims print that pertains to the March non-farm payroll survey week. We're due to hear from the ECB President, Christine Lagarde. She'll be speaking on Thursday. And also a busy day of corporate earnings on Thursday after the close. We're due to hear from Micron, obviously one for the semiconductor folk, Nike, Just Do It, and FedEx as well. So we'll see whether or not they can deliver. And then last, but by no means least, wrapping up the week on Friday, a quieter day, to be completely honest with you. We get the latest UK public borrowing figures, usually not worth paying too much attention to, but of course we do have Rachel Reeves delivering the spring statement on the 26th of March, so they will probably attract greater attention than usual. We also get Canadian retail sales and preliminary consumer confidence from the Eurozone as well. And of course Friday, it's also worth noting that it is the end of the Fed's pre and post meeting blackout period, so all of those wonderful FOMC members will be on the wires as well. Yeah. And that is pretty much it. I'm out of breath just thinking about what this week might hold. I'm sure like it's going to be a little bit of a rocky ride over the next 4 or 5 days.
Yeah, I thought you were throwing your mouse around the room at one point. I thought it was getting a bit heated. But thank you very much for that. Just whilst we've been talking, it's an exclusive from Stephen Swinford, who's a UK political journo. He's announced that Keir Starmer is willing to station thousands of British troops in Ukraine for years to maintain a ceasefire and deter another Russian invasion. Apparently, the PM is prepared to make an open-ended commitment to deploying British troops for, quote, as long as it takes, alongside Western allies in an effort to keep the peace. That's from Zach from the Slopes. And I've also just discovered, whilst Michael was talking, that he's actually going to be over there until May, so take it bloody easy. I can hear Michael Brown pulling his hair out, what remains of it. But Michael, thank you so much for today, as usual. Listeners, thank you for tuning in. And we'll see you tomorrow. Take it easy.
See you later. Bye-bye.